You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen, and I've got my co-host, Charles Steinmetz here. Charlie, how you doing today?
I'm great. I got up early. I had breakfast, so we're doing good.
Fantastic. All right, we're going to start like we usually start. Charlie, what do you want to tell me about today?
Yeah, kids are wonderful and really frustrating, from like cuddly and warm to screaming their heads off because their sandwich isn't cut in quarters instead of straight. They're just straight though.
Yep. Okay, I can appreciate that. Do I get a turn? You gonna give me a chance to?
I will allow you.
All right, thank you.
In this moment.
So
Tell me something.
So I want to tell you, and you already know this, but for the benefit of everybody seeing this as well, and hearing us, I am super frustrated with the IRS right now. So because of COVID-19 and how backed up they are, I appreciate the measures that they took to keep their employees safe. And it's super frustrating now for professionals like us because I've got people who, the IRS just didn't process their extensions and are trying to penalize them and all that kind of stuff. So super frustrating, but we're persevering. We're working through it. So first, we're going to talk about the first iteration of I say the first iteration of taxes, really before even the United States existed, right? You have an opinion about that. You want to share it, right, Charlie?
Well, I mean, so we're here, and taxes have existed for a long time, but Americans were frustrated with the tax system since before we were even Americans. That's why kind of things started in the first place.
So the Revolutionary War, of course, is what you're referencing, right? And the whole reason that America exists as an independent nation and country is because we were tired of paying taxes to what felt like a foreign king,
right.
And the Revolutionary War was fought. So taxes are certainly a frustrating concept sometimes, I guess you might say.
So if you're frustrated with taxes, you're just being true to your roots. That's all. So
very American of you, Charlie. All right, and so kind of the and taxes, of course, as a concept existed far before that. But for purposes of our discussion, we want to get as much relevance as we can. Yeah. And so then talking about America as a nation and taxation for our purposes in 1894 is when there's some wartime taxes and that kind of stuff, but 1894 was kind of the first income tax that started.
Formalized.
Yeah. Right. The first, I think the right term is probably peacetime tax, the very first peacetime income tax that was implemented. And the reality is it wasn't affecting anybody who didn't have over a certain level of income. And so it was an income tax, but really the way that I reference it is it was a wealth tax, right? For all intents and purposes, right. That's really all it was a wealth tax.
Death tax, inheritance tax, yeah.
Yeah, I think looking at the numbers, it equates to somebody earning over $120,000 of income today, and so anybody who is at what would equate that threshold at that time was subject to the tax. But your average American was not.
Less, so.
Yeah, exactly. Was not subject to that amount. So then.
By the way, sounds great to me. Let's do that again. Just throwing it out there.
Except that I like all of the military and protection and roads and infrastructure and everything that we have today.
I was talking about likes, not facts. Just likes.
What the famous phrase, facts don't care about your feelings. Okay. So that was that was 1894. That was the first peacetime income tax. But then some 20 years later, 1913 was the very first income tax that was actually legalized, right? And so that was the 16th Amendment, legalized the income tax within the United States.
Around that time is where some things start happening. We have with the legalization of it comes the enforcement of it. And so around that time, you've got the kind of the big story. There's things that people have fears on, draws on, this thing could happen. And it seems to always stem from a thing. So Capone is the thing. People have fear of the IRS coming and arresting them and taking them from their home. And it seems to draw from the Al Capone kind of story, because Al Capone was arrested by essentially IRS. That's how they got him. Bad dude, did bad things. They couldn't get him on anything because he's a smart dude. But he didn't declare all of his income. And that's how they ended up catching him, was because of that. And so
now wait, hold on, let me interrupt you.
Yeah.
You say he didn't declare all of his income. What do you mean?
So he did bad stuff and got money. He increased his wealth and didn't pay tax on the increase of his wealth. So he had clandestine things going on.
Are you suggesting that he should report his ill-gotten gains on his tax return?
Technically, you can't convict off of a tax return. So, I mean, if you are an international assassin, illegal international assassin?
Yes, it's illegal. Yeah.
Okay, so, I mean, tell me, did you buy any garrotes? Do you have any black, outfits or whatever? We'll use what we can legally. But again, you can't be convicted off of this thing, technically, but so it's declaring all of your income. And that was, again, part of the legalization and now enforcement is you're supposed to claim your income. I mean, sure, you make 50 grand, you forget $100, okay, fine. You make $500,000, you tell the IRS you made 50 grand. I mean, there's a problem, right? And that's where this thing came in. So again, the fear of tying to, they're going to come and take me away. Are you to the extreme on the Al Capone side of things, anywhere close to that? Okay, then your fear is rationalized. But if it's you forgot $100 or so, you're not going to jail. They're not coming to take you away like Al Capone in that scenario.
So then, to put it in a different way, right? Let's say, for example, you're an American that earns $60,000 a year. The way that the law is written is if you underreport your income by more than 25%, theoretically, that's when, especially with tax evasion, right? So that in and of itself is evading taxes. But then if you're trying to dodge the IRS from there and trying to make your case that everything is correct when it isn't, and all of that, when you're really trying to evade paying taxes on over 25% of your income, that's when jail time really starts becoming a consideration. So if you're underreporting your income by more than 25%, theoretically, if it's that malicious, right, of tax evasion,
Right.
then they could start entertaining that. The reality is
They just want to fine you.
they want you to pay the amount that you owe, right? The goal isn't to put you in jail, right? But the goal sometimes, Al Capone, for example, they know they just can't get him in all these other activities, right? The what during the Prohibition, I guess, was the big piece of that, and he did a whole lot worse things than just smuggle some alcohol. But they couldn't pin anything on him, right? Except they could pin tax evasion on him. So that's what they got him with, right? Was tax evasion. Crazy. So speaking of enforcement, if we're talking about Al Capone and the kind of the story of the one accountant who actually got him, was pretty incredible. But speaking of enforcement, 1953, right? So some years later, Al Capone died, I think, in 1947. So Prohibition was 1920 to 1933. They got him. I don't know exactly the year that they got him. 1947, he died. But by 53 is when President Truman and kind of his administration really created the IRS and what it is today, right? So that was the beginning of this institution, for better or for worse, right? The revenue generates over 90% of the United States revenue. So I personally like the freedom that I experience in this country. I like the infrastructure. I like sometimes the government, so I like what I receive as an American citizen. But the IRS has some issues. What are your thoughts on the IRS, Charlie?
What's the saying? If you don't have anything good to say, you don't say anything at all.
Fair enough. No problem. Deflection there. Okay, so moving on. During that time period in which the IRS was created and the first really major tax reform bill. Now I say major, there are plenty of tax changes from the implementation, inception of the 16th Amendment in 1913. up until 1986. But during the year of 1986, the Tax Reform Act was passed. So tell us a little bit about that, Charlie.
And it was big. It had over 300 provisions, and it was it's the biggest change until recently, but the biggest change that happened really in history to the tax code. The frustrating thing, and we'll see some more of that as we keep talking, is the tax code itself really wasn't changed. It's like Band-Aid on top. And that's what's going on, is you have this giant Band-Aid on top of the tax code. And then really starting with like President Clinton, everybody has tried to modify or extend the Band-Aids. And like every president since Clinton has then done something to that Band-Aid, as it were, either helping it limp on or trying to change it or create a whole new Band-Aid.
Yeah, and of course, speaking of presidents who changed the tax code, now since Clinton, probably actually a little before that, I hope you'll forgive our age, because I wasn't into politics prior to that administration, but taking presidents into account, and especially it being an election year, right? 2020, right now, what? It's September, so just to give you some kind of time frame of when we're having this discussion. Now it feels like every single president since then, they have to have a position on tax reform, right? Generally speaking, it's popular to have a position of simplifying the tax code. The reality is, and so I'm gonna go on a soapbox for a moment. So give me a little bit of a break. And Charlie, you've heard this 100 times, but I don't think a simpler tax code is a better tax code. Our tax code is incredibly convoluted, super complicated, can be very frustrating sometimes, but the reality is we have one of the most sophisticated tax codes on the planet because of how complex it is. Now, I agree that there are some areas that are too complex, right? We start talking about farming. Farming's got some really incredible credits. And you think about how we got there, right? Because we want to incentivize farming in the United States. People need to eat, they need food. We can only import so many types of food, grains and that kind of stuff. But fruits and vegetables, importing that stuff's terrible by and large, right? And so that has to be homegrown. So there's a ton of credits for that. Well, I think that's a good thing. If I'm a farmer, I'm happy about the tax credits and the incentivization of my business. And so it's in that way that I use the word sophisticated as opposed to complicated. It is complicated. I prefer the positive connotation of the word sophisticated, right? Because that tax code
has evolved a lot over time. Also, as Americans, we're true to our roots, we're fresh with taxes, and so we try to circumvent or at least change the method in which we earn our income. It's not just go to work and come home. There's all these different types, and so we've had the tax code has had to adapt based on it. And so you've got your wages, you've got, like I said, the farming, the business side of things, you've got your stocks, you've got your corporate things, you got your municipal bonds. There's all kinds of different levels or ways to earn income, and the taxes have to adapt around that to incentivize certain things. You would never just take part in a municipal bond because it pays less than something else. Why would you ever do this? Well, let's make it tax free. Well, maybe we'll get some people into that. So they had to change things to do stuff. Yeah,
that's totally true. But again, because it's an election year, right? Speaking about taxes and the politicking that's surrounding kind of having a position on tax reform. I mean, this year, right? So during 2016, right? The campaign in 2 different campaigns in 2016, tax reform was a huge subject, right? President Trump said that within the first 100 days, he was going to, every president had their first 100 days. They've got a lot planned, or at least they declare they're going to do. Took him a little bit longer than 100 days, but he ended up passing the Tax Cuts and Jobs Act, which I don't want to put the cart before the horse. We'll get into that. But Hillary Clinton, same thing. She had a position on tax reform too, right? Everybody has a position on tax reform. What's interesting is this year, because of the global health crisis, right? There's been very little discussion about kind of tax reform.
It exists. It's just not prominent.
Yeah, it's just not a big piece of the conversation because there's so much other stuff that's going around. Biden certainly has put forth, Joe Biden has certainly put forth a couple of, or his tax plan, if you will, and we've had a look at that. President Trump has talked a little bit about his kind of middle class tax cut. Yeah, that he's ready to put forward. And so a lot of talk. We'll see what actually ends up happening, and we'll see after the results of the election. But what I always tell my clients is, politics and the political spheres is inextricably connected to the tax code, because the two are connected in the sense that a president comes in and expects to have an impact or a change on the tax code, and so that's kind of historically relevant for sure.
Well, jumping back into the facts of things, going back to 1986, we kind of jumped into the presidents and everything. One more change that happened at that time was electronic filing, something we haven't had necessarily before, which is a big component in an improvement in taxes. It helps people and it helps them. It is very nice just to be a number in the system and let a computer run over stuff versus having some of that fear from before of a human looking over every single tax return.
Well, yeah, and on top of that, how complicated taxes were getting over the years. So prior to that, you just and some of you will remember this. You just got your 1040 in the mail, right? The IRS just mailed it to every single person.
One page.
Yeah, or maybe a couple, but yeah.
Started.
Yeah, and it was just your basic 1040 packet, and it was just a math calculation. This plus this minus this at this percentage rate equals this, and that's the outcome. And then they introduced things like the alternative minimum tax, right, which is a secondary tax calculation that happens outside of your regular income tax. It's an alternative minimum tax, and it minimum has a certain positive connotation to it because you think, hey, a minimalized tax. That's not the case. It's an alternative minimum tax, meaning it's a higher floor of tax in many cases.
Well, I describe it with those that I meet with when we talk about AMT. For those that it affects, basically I say, if you've been subject to this and you know a little bit about it, it turns into like a vulgar word.
Right. Yeah, absolutely. Major negative connotation if you know what it is.
Right.
And if you've been affected by it, you know what AMT is, right? Alternative minimum tax, no fun. So yeah, electronic filing. Now, just because electronic filing started in 1986, it wasn't really prevalent at that point, right? The technological kind of evolutions that happened in the 90s helped quite a bit. By 98, 99, I think it was it was at about a 50%. Well, it was about 50% rate at that point. And then it has increased dramatically since then. Right. But here in 2020, right, we've had 21 years or so to really perfect it, if you will. And they've done, frankly, a pretty good job. I mean, there's a rejection system if you file your tax return electronically and there is some type of error. Let's say, for example, you've got a 17-year-old child living at home in high school. They work a part-time job for some gas money, and they get their W-2 and they're so excited. They get their $60, $70 refund, but they made the mistake of claiming themselves on their tax return. Yep, facepalm, exactly. Then when you try to file your tax return, it rejects because that child's social security number has already been used on another tax return. So it's super common, a reason why something rejects. We see it all the time. I tell all of my clients, when your kid gets that W-2, just grab it, hold tight, and just bring it to your tax appointment, and let me just look at it, right? Because if I can see the numbers, I can advise you correctly on it. It's those little things that through e-filing, it wouldn't have been caught if you both paper file.
Right.
You're getting a letter from the IRS, right? And who wants that nasty gram saying you owe them a bunch of money?
Right.
Yeah. And so anyways, the electronic filing system, in my opinion, has dramatically improved many people's filing experience. So filing the tax return.
Filing twice on accident, or
exactly.
Kids being claimed multiple times, just the simple, easy things being able to catch. So
yeah, and of course it saves the IRS a bunch of time because they're not processing these paper returns and all that. It's computer that's processing. So big benefit, not just to the IRS, though clearly to the IRS, but also to the individual taxpayer, I think, as well. pretty significant.
Right.
The other thing that I want to mention is starting in 1986. In fact, let's talk about it historically, actually. After the implementation of the 16th Amendment, there was a lot of changes to the tax code over a period of time. The top tax bracket between 1913 and 1986 was 92%. 92% was the top tax bracket, which is...
So I said earlier, I liked what you were saying. I don't like it so much.
Yeah, 92% is pretty crazy. I mean, you're basically working for the federal government at that point, right? Because you're paying the income tax on 92% of your income, and so you're only actually getting 8%. Now, it has to do with levels, right, of income, right? Not everybody was being taxed at a 92% rate. In fact...
If you meant like $2 million at that time.
Yeah.
I didn't know the conversion, but that's a lot of money.
Right. The reality is you can look at the effective tax rates during that time. There are a bunch of charts and just analytical data that shows that the effective tax rate at that time, the top effective tax rate, was around 47% or so. So, 92%, sure, that sounds awful and scary. The reality is there were a lot of loopholes, and I usually hate that word, and I almost never use it because there's not a lot of loopholes at this point. True, but there actually were then, right? It's where the stigma comes from, right? Because there actually were a bunch of loopholes at that point. And so the effective tax rate was the effective top tax rate was around 47%, which is, in line. In 1986 with the Tax Reform Act, the top tax bracket was 38.5%. That was a very top tax bracket. So clearly some significant changes to the income tax code at that point. So now kind of
caught up, as it were.
Yeah. So now it's just now. And I say now loosely, right? Because we're talking over the last 20 years. We got all the way up to like 1999 as far as the history so far. And now we're going to talk about some of these things that are a little more recent. Yeah. Charlie, tell me what happened in I want to call it 2017, December 17, 2017. What happened?
I was born. I'm very young. So we had the Tax Cut and Jobs Act. So that's when things started to change greatly at that point. And so there was one Bandaid example. It's almost like a whole new giant Bandaid on top of the tax code. So we really didn't want to revert back to this crazy percent type stuff. And the administration, as it were, there was an election. And so that agenda got pushed forward. This is what we're ended up with, which... there's pros and cons. There really is.
Yeah. So they added 1,100 pages to the tax code, right? It's the biggest tax law change since 1986 when the Tax Reform Act was passed. And so pretty historic, pretty big deal. It's going to be a big deal for years to come, I think. Yeah. Now, initially, the Tax Cuts and Jobs Act is set to expire in 2025, right? So that's when it's set to expire. But the Bush tax cuts, which nowhere to this extent, but still pretty significant. The Bush tax cuts were set to expire in 2008, I believe, and
just kept limping and limping.
Yeah, they kept extending it year by year by year, and in fact, some of those were made permanent, right, and no longer have expiration dates. Now we're just permanently in the tax code. Right. So the reality is, and historically speaking, when you reduce people's taxes, you really can't afford to then increase them, because when you reduce people's taxes, they take that money, they put it into the economy, they get used to it, that kind of stuff. They increase their quality of living, which as a financial professional, don't do that, right? You get a raise. A portion of that should go to your savings. A portion of that should go to your retirement. You shouldn't just immediately increase your quality of living. It should be a gradual increase, absolutely. But I've got people who, I'm going to get this, $80 a check increase based on this raise. So yeah, the idea here is when you get an increase in your take-home pay, right, a portion of that should go toward savings or retirement, debt, that kind of stuff, as opposed to just immediately increasing your quality of living.
Taking on another new debt. Now we can afford this.
Right, yeah. Absolutely. So going along those lines with the Tax Cuts and Jobs Act, talking about some of the changes that came into place. The tax brackets changed. The tax brackets are pretty crucially important, right? Because after all of your income and deductions, right, we come up with basically your taxable income.
Right.
That number is what your tax is based on, right? Your taxable income at your tax bracket. And we're going to have a future episode talking about tax brackets. And so one of the most commonly misunderstood subjects. So I'm really excited to dive into that one, but I won't spoil it yet. But essentially, these tax brackets determine at what tax rate you pay, right? And so the tax brackets went from 10%. So I want to just list a couple of the more common tax brackets. Prior to 2017, we had the 10% tax bracket, the 15% tax bracket, 1.5, the 25% tax bracket, the 28% tax bracket, the 33% tax bracket, and so on. There were a couple more. But less common. So now, after the passing of the Tax Cuts and Jobs Act, we are at the 10% tax bracket, still same, 12% tax bracket. So 12%. Yep. And then we've got the 22% tax bracket.
Also down by 3.
Yep, as opposed to 25, and the 24% tax bracket.
It's down by 4.
Yep, 28 down to 24, which is awesome. And then the 32% tax bracket as opposed to 33. So that should give you an idea that the brackets just shifted down a touch. And so for individuals, that's super helpful to pay less overall income tax. But what the federal government actually ended up doing is, instead of you just filing 1 year and getting, let's just call it hypothetically, a $500 refund, and then the next year your tax goes down by, let's call it 3% on average, which equated to another $1,000 refund. Let's just hypothetically, right? So now, instead of getting your $500 refund, you would have received a $1,500 refund.
Right.
But the federal government says, yeah, but that puts money in your pocket a year from now. I want to put money in your pocket right now.
I want you to spend more money right now.
Right, because the more money we spend, the better the economy does, right? So the macroeconomic theory here is we want a whole bunch of people to spend a whole lot of money, right? So how do we strengthen the economy? Is we get more people spending more money. That churn is what strengthens the economy pretty significantly. And so as part of the Tax Cuts and Jobs Act, we'll reduce the taxes, but then we're actually going to forcibly reduce your federal income tax withholding at your job.
All right, so payroll. They told payroll, you were doing this number, make it smaller, essentially. And the goal, they did a lot of homework. They really did, right? And their goal, they can only plan on so much. I mean, if you were a single earner working one job, the math worked fine.
Yeah.
Not everybody's a single earner working one job. And so the math got cattywampus for a lot of people.
Yeah, depending on how many kids you have and depending on how much you earn versus your spouse, if you're married and all that kind of stuff, your filing status, married filing joint versus married filing separate, all of these factors. Remember, I talked about how, I'm going to use the S word, how sophisticated the tax code is as opposed to complicated. Remember, I really prefer the word sophisticated. But the problem with this level of sophistication in our tax code is that then you can't make blanket changes like this without it affecting people differently because of how different people's tax treatment is. Now, sure, the average American may just be a W-2 earner and it may not be that big a deal. But the reality is when we did the tax return for 2018, so the Tax Cuts and Jobs Act was passed on December 17th of 2017, but it didn't really, most of the provisions didn't go in effect until the following year. So
it wasn't retroactive.
Yes.
It just said, hey, so we did the tax returns in 2018 for 17, all the normal, same old stuff, but we're in the midst of the new rules. And
So then we live throughout 2018. Now we filed a tax return, right, by April 15th. Hopefully most of you, in 2018, early 2018, but that wasn't the new provisions, right? We lived through 2018, and then starting in 2019, that's when we actually reap what was sowed, right? For all intents and purposes. The tax law changes that happened, we saw them on our tax return in 2019. 2019 was an interesting year because the federal government forcibly reduced withholding.
Right.
Now, the idea was your withholding goes down, but then your taxes also go down exactly to match. And if it matched exactly, then
there was little to no change.
Yep. Then in that hypothetical scenario of getting $500 refund,
Correct.
you got a $500 refund again.
Yep.
Only in this scenario, you got an extra $50 a check.
But you also paid less tax.
Right.
So let's say your tax, you were supposed to have paid $2,000 in tax. Prior, you did. You overpaid by $500, you got a $500 refund. This time you're only supposed to have paid $1,600, $1,200 in tax. It was less because the percentages were less. But you overpaid by the same amount, you still got a $500 refund. That was the plan. And for many, it did work.
Yeah. But you heard a lot of people complain early 2019 because their refunds went down. And so some folks, right? If it worked, it worked great. It worked perfect. My tax went down. My take-home pay went up. My refund stayed the same. That sounds like a really fantastic deal to me. But what was happening is people's take-home pay was going up, right? So let's say you were collecting $2,000 more a year, which was the most common number, right?
Sure.
Around $1,800 to $2,000. You were collecting that much more each year. And then your taxes go down by $1,500. Right, so you take home $2,000 more, but your taxes didn't go down $2,000; they only went down $1,500. Now that $500 refund is zeroed out.
Right.
So now you get no refund, and you think, "Oh, this is awful. This new tax code change is terrible. I lost my $500 refund." To that I say, you took home $2,000 more of your own money.
Correct.
So if I offered you $2,000 or $500, which one are you going to take? Now the reality is that if people see an extra $50 in their take-home pay, what are they going to do with it, Charlie?
Spend it.
Yeah. And that was my warning to you earlier. You can't just increase your quality of life when you see more money each check. And you should frivolously spend some money. Would you agree?
You got to do something.
To an extent,
yes.
You should have some level of financial outlet, something you enjoy, hobbies, date nights for me and my wife, movies.
6 of guns.
Movies, Charlie, are ridiculously expensive these days.
I don't do it anymore. I'm done.
Netflix,
sorry,
and
industry,
Hulu, and
yes.
Disney Plus. I was watching a movie last night, Disney Plus is not a sponsor, but we would take you. But in this scenario, right? My wife and I like to spend money just like everybody else, right? But when we saw that increase in take-home pay, right, we were strategic and deliberate in what we chose to do with that, as opposed to just $50 more check, and I'll just blow it on Starbucks or whatever.
Mm-hmm.
So that's another piece, right? Talking about the tax brackets, the withholding changes, that gets pretty complicated. As you can tell, Charlie and I are passionate about this kind of stuff, but not the most interesting topic. So we'll move on from the individual income tax rates. Let's talk about the corporate tax rates. Actually, those changed pretty tremendously. So now I'm gonna go on my soapbox here for a minute. Okay,
it's like your third one.
I have a lot of soapbox moments. Okay, Charlie. Now Charlie knows this, so I'll give you a little bit of background info. Charlie and I probably first met. We were like 8, 9, 10. Charlie's a year older than I am, right? But by
very important.
super. Also a little bit taller. Not quite as good looking, but we'll take it. So then what we've got is
That's real quick. Step out in the hallway.
We're not taking this outside. We're not taking this outside, Charlie. So Charlie and I really became really good friends around 10, 11 years old. And Charlie and I have been best friends since then. And so we grew up together and through thick and thin, causing plenty of mischief and our parents lots of grief. But Charlie, how long have you been at Molen Associates?
10-ish years, a little bit more.
Yeah.
So officially, like a full payroll salary. How long have I been setting foot in the building, as it were?
Long time.
A lot
since it existed, yeah.
A lot longer.
And so I've worked here at Molen Associates since I was about 10 years old. My folks started the company about 40 years ago. And so anyways, just to give it a little bit of that background. So a lot of this kind of repartee back and forth between Charlie and I has happened for many, many years. So soapbox, right? Got to get up. We got to get a soapbox somewhere.
I'm trying to divert you, but
no, it's not going to work. So soapbox for a moment. corporate tax rates. So first, let me give you what changed in the Tax Cuts and Jobs Act, and then let me tell you a little bit about how I feel about corporate taxes. Okay, so the corporate tax rate went from about 35% down to 21 even, right? It's not a 21 point whatever it is, 21%. That's a dramatic reduction in tax, right? Now, a really sore point amongst a lot of people is that corporations have millions or billions in profit, and they don't pay income tax. And they say that that's wrong. And I'm not going to argue the validity of whether that's right or whether that's wrong. What I want to tell you about is a misconception, okay? Because if you were to tell me that corporations don't pay tax, I'm going to tell you you're wrong. If you're going to pay me that corporations don't pay income tax, I'm going to tell you that you're mostly right for some of these larger corporations that get a lot of government incentive so that they can hire more people, right? And so Amazon is the most common, Jeff Bezos and Amazon is the most commonly pointed to example of someone who's worth billions, and Amazon didn't pay any income tax this past year. And again, right or wrong, I'm not going to tell you, what is right and what is wrong, but I'm going to tell you that Amazon paid more in tax in 2019 than any individual will pay in their entire lifetime. Okay, so I don't mean income tax though, right? They pay more in tax. There's a lot of different taxes, but let's just use the employee taxes as an example. When you earn money at your employer, you see that FICA taken out, right? That Social Security and Medicare, that represents essentially 7.5% of your earnings. Your employer matches those contributions to Social Security and Medicare. So they pay 7.5% as well. Together, the two of you pay 15%. Well, Amazon pays 7.5% on not just your W-2, but everyone at the company's W-2. Right. They pay more in tax in a single day than I will pay in my entire life. So the myth that corporations don't pay tax is wrong. That corporations don't pay income tax is mostly correct. The difference is that as individuals, we pay a lot of income tax, or it depends on how much income you have and that kind of stuff. Sure. But you're going to pay some income tax for sure, because your employee tax is only 7.5%, but your tax bracket may be 22%, right? Mm-hmm. And so in that scenario, you're going to pay a lot more income tax than you will any other tax. But you're not paying anybody else's employee taxes. You're just paying your own. Right. And so okay, now I'm off my soapbox. So the corporate tax rate went from 35% down to 21%, right? Right. The theory there is that corporations hire people. So by them having more access to capital, they can hire more people. And we saw the increase or the reduced unemployment pretty significantly for two reasons, actually, right? And I don't want to get too deep into the macroeconomics of it. But again, this is historically relevant. This is the history of taxes. So the macroeconomics of this is when people get more money each check, and then people just frivolously spend it, right? Which is a large majority of what happened. Yeah. Then that it increases the need for jobs, right? Because people are buying more products. The more products people are buying, the more profits corporations have. The more profits they have, the more people they hire, so that you can spend money to make money, right? That's the macroeconomics, the theory of the thing. And so we saw that. That's part one. Part two is the reduction in corporate tax, right? Again, same theory. Corporations. Now the reality is many of these corporations aren't paying income tax. So when people complain that corporations don't pay enough income tax, and then they complain that the tax rate for corporations went from 35% down to 21%, I'm like, now you got to pick one or the other. Either they pay taxes and now they pay a lot less, or they were never paying taxes in the first place. Both are not a problem, right? And in fact, my opinion is neither are a problem, right? But I digress. I'm off the soapbox already, Charlie, I promise. The theory here, macroeconomics wise, is that unemployment rates will plummet, which is realistically what we saw. Now, COVID-19 is a whole nother matter, right? And certainly want to be sensitive to all of you who lost your jobs during the global health crisis. Sorry that happened, but hopefully we're going to see a V-shaped recovery. I don't know, things are indicating that we are at this point. So that V where we went really far down, but hopefully we're going to climb right back up to where we were or more. We'll see. I mean, indicators are that may be the case, but we got a interesting couple of years ahead of us for sure. For sure.
So kind of diverted a little bit from the
Yep.
TCJA, which is okay. These are things that are relevant to it.
Yep.
Is there anything more on the TCJA that we wanted to cover in specific? I know we had some things written down, but
Yeah, why don't you tell me about the child tax credit?
so there's child tax credit. So there's credits and deductions and taxes, and they actually math very differently. And there's two pieces of child tax credit that are important in this whole thing. One is the dollars themselves. They changed. They went up, basically. For most
So
people,
give me some context.
so for most people, it doubled in essence. So what was a $1,000 child tax credit is now a $2,000 child tax credit. Now, if your tax is so low that you're just getting a refundable portion, that's a little bit less, but in essence, it doubled
It's still increased.
from what it was. And so it was an increase for kids under 17, you just get more taxes, which when they changed all the payroll stuff and people had less in tax, and then it was further, compounded by having multiple children, it was just great for you. So you had a great year that year in that one. The other aspect of the child tax credit that was important was the change in the phase out. So the phase out is a magic word in the tax world, is what I describe imaginary lines in the sand the IRS has drawn that once you're over this, it becomes less beneficial for you. It's not a black and white, you cross the line, it's now done. It's just less beneficial. There is a done point. And for those prior, the $1,000 child tax credit, that line in the sand was pretty early in the income stages. It was
So what range we
it
talking?
was like $110,000 of income type of deal. And so it was
Now
lower
talking about the
ranges.
math real quick. I'm a math guy,
Yeah.
so sue me. The math behind it, right, is for every $1,000 more you made. So starting at 110 up to 111 and 112 and 113, every 1,000 more you made, it knocked off $50 off of the credit. So if it's a $1,000 credit, it takes $20,000 in order to get rid of the credit entirely. Now that was on a per kid basis, right? And so theoretically, if you've got 8 children under the age of 17, your phase out range is really, really high before you get no benefit from the child tax credit.
$200,000, you're still getting some.
Yep.
But you have one kid, $200,000, there's no child
So what
tax
are we
credit.
looking at now?
So now it's for a married couple, it's in excess of $400,000. So you've got 400. I mean, it really opened up that range. The call middle class, higher middle class people. who
Yeah,
weren't
Charlie,
getting-
400,000.
Well, and the lower side too. I mean, those making a couple, both dual income,
right. Yeah, for sure.
2 kids making $160,000 a year, no child tax credit.
Yeah.
And then immediately they just get $4,000 off on their taxes because they have 2 kids that are 17, was a dramatic change for
Yeah,
them.
for sure.
And so that's where I say still in my eyes, higher on the side of things.
Oh, yeah, for sure.
Yes.
Now the reality is even if you're earning $20,000 a year, right, or $40,000 a year as a single filer, and you've got kiddos under the age of 17, it still went from 1,000 to 2,000, right? It still doubled,
So,
but it did unlock it for more people who weren't getting it before. Yeah, for sure. Okay. So now talking about those income ranges, actually, it will segue us nicely into the change to the standard deduction.
yes.
So the standard deduction, the words, I know Charlie uses different words. He and I have been doing taxes for a long time. We've done thousands and thousands of tax returns at this point, as well as dealing with the IRS and all that kind of stuff. So we have some pretty evolved verbiage and predetermined verbiage that we use to answer most questions, because clients ask me a question, how much is the standard deduction? I've answered that question thousands of times, right? And so for me, the verbiage that I use is it's the government freebie, right? The standard deduction is what the federal government says, you're going to get this to deduct. Or if you can claim more than that, then you can claim the itemized deductions, right? The older verbiage was long form and short form, right? Because remember, they were mailing out forms, and so it was a shorter form to take the standard deduction and a longer form to take the itemized deduction. So it used to be called long form, short form. The reality is it's the standard deduction or the itemized deduction. And so in this case, the standard deduction for a single filer was about $6,000. For a married filer was about $12,000. For head of household, that's kind of that in between, was $9,000.
It was indexed for inflation, so it changed a little bit every year. But yes, that's right from the rough numbers.
Yeah. And it's increased a lot in the last 25 years.
Right.
So index for inflation. Thank you. But then with the change, they effectively almost doubled those standard deductions. So for a single filer, you used to just take off $6,000 approximately if you didn't have other itemized deductions. So let's use the example that I had mentioned before of about $40,000 of income with 2 kiddos. You were taking a $6,000 deduction. So now you're reporting $34,000 of income. Well, yeah, but that $6,000 under the Tax Cuts and Jobs Act doubled. So now it's $12,000. So now you're not reporting $34,000 of income. You're only reporting $28,000 of income, right. And the math is a little more complicated than that. I'll dive into it. But then the child tax credit doubled, right? So you look at all that and you think, wow, Kevin, that's amazing. Except we have neglected to mention one thing, and that is the removal. So not the addition, not good, right? The removal of what was called the exemption deduction.
Right. The deduction you got per person, and so every person tax return allowed an extra deduction, and so in a way, while this other deduction went up for those with bigger families, your total freebie deductions went down.
Yeah. And then the credit went up, so it's a lot of math, right?
Right.
Which is where everybody asks, did this help me or did this hurt me, right? Essentially, did the Tax Cuts and Jobs Act help me or did it hurt me? And the right answer to almost every question, Charlie, is it depends, right? For almost every tax question is maybe. It depends. It depends on your specific circumstances, right? So if I could take a look at your 2017 tax return and your 2018 tax return, I could quantifiably answer that question. It is a yes or it is a no, and it's that simple.
There's also a difference in how we look at a tax return, though, and what is better or worse, because the common American is going to look at it and say, $300 refund, $500 refund. This is quantifiable. I can tell you which one is better. That I would argue all day long. Okay, great. Make work take an extra $500 out of your paycheck. You'll have a giant refund. Therefore, it's better, correct? No, it's not correct. So the tax
you lose the money each check, right? Yeah.
Correct. It's just the bottom line number technically isn't what makes your tax return good or bad.
Right.
The important number is the tax reuse liability, your tax burden, right? How much after everything has been said and done is the government keeping of your money, right? And so $300 refund, $500 refund, okay, but what if you have $5,000 of tax that they kept and is never giving back, or $2,000 of tax that they kept and they're never getting back? I don't care what your refund is at that point. You could owe $2,000, not pay a dime in, and get a $300 refund. This is still better for you.
Yeah.
So that's why when Kevin is saying, I can take a look at the tax return and quantifiably tell you which one is better, was it an improvement? We want to be clear that we're looking at it a little bit different than you're going to look and see one number, but why did you tell me? Because of this.
Yeah, and then it gets even more complicated, because would you rather pay more tax or less tax?
Right.
Assuming the tax rates are the same, I would rather pay more tax. Why on earth would I rather pay more tax? Because it would correspond with higher earnings. I would like to have higher earnings, which results in higher tax.
I want to pay $1 million in taxes every year.
I would love to pay $1 million in taxes, right? But you know, that gets too deep into it, and we do need to move on soon. Let's cover two last things in regards to the Tax Cuts and Jobs Act, and that is the removal of Form 2106. So we're not going to go too in depth into this. The Form 2106, that form allowed you to deduct expenses as an employee of a corporation or a business. So let's say for a moment, one really common field is sales, right? You got a lot of miles, you got meals, you got a lot of expenses as someone who works in sales. And maybe your employer gives you an expense account.
Sure.
In which case, no problem. You're not out of pocket any expenses, no complication. But if they don't give you an expense account, and really because you earn commission, the expenses are up to you, and the more expenses you have, theoretically, the more commissions you earn. And so, however you want to structure it is your choice. In that scenario, we, prior to the Tax Cuts and Jobs Act, could deduct those expenses.
Right.
And that form was completely eliminated from the tax code, which was a big hit to some few folks.
Correct. It's a big frustration point for those folks as well, because your opinion is kind of an important thing to every person, right? Your opinion is, I have to do this. I have to incur this expense. And you've operated your whole life being able to justify, if I have to do this, I get to deduct it via work, right? Mm-hmm. And that's not only the case. So military, there's like one other exceptional traveling performers, but basically if you are an employee, you can't deduct it, period.
Yeah.
It doesn't matter how needed it needs to be.
Now, if you run your own business, it's a little different. Correct. Okay, so we don't want to conflate too many things. I use this example quite often, but your friend who gives you tax advice is, to me, like WebMD is for a doctor, right? So the doctor hates WebMD because WebMD is always going to tell you have cancer. Whatever your symptoms are, it's like you have cancer, right? Or whatever. And so people think they know based on going to WebMD and putting in their symptoms. And they go to the doctor saying, I have this. And the doctor's like, yeah, that's cute. But the reality is based on these other factors, you don't have that. You have this instead, right? But the patient comes on with a presupposition. Right. In that same way, it's unreal the amount of non-compliance in the tax world, and just the significant misunderstanding that most people have with taxes. And so we want to clear that up, which is why we're here primarily. But you've got the friend who comes in and tells you, hey, my accountant or my tax professional told me I could deduct X. So then that person comes in to see me and says, hey, my neighbor got to deduct X. I want to deduct it too. I'll give you a prime example. One of my clients came in and said, I read this blog post that said that I could write off a breast pump because she was a nursing mother. So I could write off this breast pump as a medical expense. Yes, the answer to that is yes. You actually can write that off as a medical expense. Unfortunately for my client, she took the standard deduction. She didn't itemize her deductions, which means she took the government freebie instead of being able to come up with more to write off than that freebie.
So she had less, even including the breast pump.
Yep.
Her deductions were less.
Yep.
So we want a bigger number, a smaller number.
Yep, exactly. And so she says to me, Kevin, I want to write this off. I say, great, I'll put it in here, but it's not going to make a difference. No, Kevin, you don't understand. This website told me I could deduct it. No, I really do understand. I really do. But I need you to understand that while, yes, it is deductible, it is not applicable. Because do you want to write off $1,000, including the breast pump, in your itemized deductions? Or do you want to take the $6,000, or under the Tax Cuts and Jobs Act, the $12,000 standard deduction, right? Or if you're married, $24,000, right? Do you want to take these higher number, or do you want to take the $1,000? Well, Kevin, I want this number. Great. Then I want to give you that number, and I want you to save more in taxes. No, but Kevin, you don't understand. This website told me I could write off the breast pump. Right, so you understand it's that difficulty of understanding what you can do, what you can't do, and why. And so that's why the answer to so many questions is maybe. Last thing I want to hit on, historically speaking, one of the really significant changes that affect almost everybody, or will affect you at some point, is the change from the old rules when selling your home to the new rules when selling your home. So Charlie, we don't have too much time to cover this, but can you give me a quick explanation?
Yeah, so the old rules were we're not going to go in generation. A lot of old rules were, I sell my house, I have to take that money and put it into the new house to avoid taxes. Great. Had its own things, but that was what it was. It has been replaced. So to tell someone, no, that doesn't matter anymore. Wait, what? It's interesting. But that's what it used to be. It has been replaced. Basically, the replacement is just orders of magnitude better. And so the better is now you have your single, married, and double numbers. But as long as it's been your home for more than 2 of the past 5 years, 5 years is the look back. It's been your primary residence. You lived there. You didn't just buy a house in Maine and sit here in Houston. Then you can just, of the gains, technical thing in that, more than you bought it for, a single person, $250,000, you don't have to pay any tax. It's not that you have to take the money and put it in the next house. You just don't pay the tax. Married couple is double that number. And so what I tell folks is, look, you can sell this. How much are you going to sell it for? $280,000. Fantastic. How much did you buy it for? $200,000. That's a good job. Okay, great. Yeah. You've been there for 6 years. Okay, cool.
$80,000 of gain.
$80,000 of gain. It's less than 250 or 500. You pay no tax. Period.
Yeah.
Fantastic. You go buy 100 scooters. I mean, don't. Please put it to the next house. That's what I tell people. Literally, I will take this thing. But that's what the new
So it's so inculcated in people, right? The older rules of I have to roll the money into the new property, the new house in 3 years. That's what's the old rules. You have 3 years.
Wise to do.
And most of you may do that. But what if you wanted to hold back $20,000 to pay off that credit card or buy that furniture for the new house or whatever, right?
You're worried about the tax.
It gives you some flexibility. Okay. And that's only for your primary residence, the principal residence exclusion. Okay. So just wanted to touch on that point as well. It's probably top 3 of my most commonly asked questions.
Sure.
And so, we answer those quite often.
It's the best aha, I think, of what the questions that we have to go to is to give this answer. That's so much better than I thought. I love that.
Yeah, for sure. Okay. What we're going to go ahead and do then is wrap up the Tax Cuts and Jobs Act conversation and kind of the now history. And I think we're going to instead take this over to what we like to call the comfort zone. So Charlie and I are going to be in our comfort zone, and we're going to be asked a question or two. I don't know how many we have on the docket today, Clark. Clark is our operator here behind the screen. Thank you, Clark, for everything you do. But Clark's going to ask us a question or two, and Charlie and I have not heard this question at this point, and he and I may differ in our answers. It's important to note that taxation, while it is written, documented, it's law. The IRS using that law, the exacts, the specifics, taking it into tax court, the IRS's attorneys lose about 50% of the time in tax court. Okay. Now, how could they lose if it is just objectively right? It's because it's not. The tax code
facts and circumstances
is subjective.
Individual
Yep.
is.
It depends. The answer is almost always it depends. You are going to get tired of hearing me say that, but the answer is almost always it depends. So I promise we won't give an it depends answer in total to Clark's question.
I don't promise. He promises.
but we'll go ahead and get in our comfort zone now. Clark, hit us. What you got for us today?
Well, I've got 2 questions for you. One will stay in your comfort zone. The other one, maybe not so much. It's not quite tax, but it is financially related. But I know you guys are good there too. So the first question is, when should I form an S-Corp? If I'm currently functioning as an LLC business, when is that point where I should create an S-Corp?
I dare you to not say it depends.
No, I'm not going to take that. I'm not going to take that dare because it does depend. But what I told you is I wasn't going to use that as my only answer, right? So let's jump into the detail. This gets kind of complicated, Clark, so we're not going to dive into it entirely. But let me give you the quick answer that I give to a lot of my clients. When you are a sole proprietor, meaning you're not incorporated, right? You're just a sole proprietor. It could be an LLC, or it can just be a DBA, or it could be neither of the two. You're just doing business, right, for yourself, and you're earning money. You pay an extra tax called the self-employment tax. Now, this self-employment tax is really not extra in the sense that if you're employed, you're paying 7.5%, right, of your wages as a tax. This represents that same 7.5%, except for as an employee, your employer's paying the other 7.5%. So together you pay 15%. In this scenario, you don't have an employer paying the other 7.5%. You are responsible for both shares of the 15%. So that self-employment tax can literally eat your lunch, right? I mean, it's really ridiculous how much money that can cost you. There comes a point at the profit in your business where it is superior to become an S corporation to reduce the impact of the self-employment tax. So I'm not going to dive into the math, but I will tell you that essentially that number is around $40,000 to $50,000 of profit from the S corporation.
After expenses, make sure it's really clear. Profit is you make all your money, you take away all the deductions, what's left over.
Yeah, thanks. Yeah, for sure.
Is the profit side of things. So once your profit hits that amount, it becomes, I like to use numerically beneficial. It's worthy of serious exploration. Is this right for us? Right? There may be other considerations that would deter you or warrant your desire to be an S corp. But from our stance, the numerical side of things, hey, this is really worth your consideration, your time to explore if this is going to work.
Yeah, for sure. And then talking about the kind of numeric side of things, if you've got that $50,000 in profit, or let's say you have $30,000 in profit, and we run a simulation and I say it'll save you about $300 or $200 in taxes to do this, but it's going to cost you more money to actually set up the S corporation, to file the S corporation, to have the separate records and all of that kind of stuff. You see where I'm coming from, right? It's just not worth it. But let's say at $50,000, and these numbers aren't representative of reality. I'm just trying to give you an idea, right? Let's say at $50,000 of profit. So you got $1 million in revenue and $950,000 of expense in order to produce your product or your service. So you got $50,000 in profit. Let's say that it saves you $8,000 in tax. $8,000 is a lot. And if you say, man, Kevin, this is going to cost me another $2,500 in my time and money and everything, but that difference in tax savings, you say, man, that $3,500 or $4,500 more in tax savings, that amount in savings is worth more to me than what the kind of my time and the costs and all that kind of stuff. So then in that scenario, everybody's threshold is going to be a little different, right? Because for me, if I can save $1,000, I might do it. But for you, if it causes all these extra headaches and these record keeping and this extra filing every year with different deadline dates and all of that causes you to, and let's say you only save $2,500. You say, man, Kevin, $2,500 in savings is not enough for me to warrant setting up the S corporation. That's the tax side of things. There's also the legal ramifications to having a taxed entity, or sorry, that's the wrong phrase, to having an entity before the IRS and all of that. Because S corporations don't pay taxes. They're what's called a pass-through. They pass the profits onto the owners, and the owners pay taxes, not the S corporation. Again, it goes back to the myth that businesses, that corporations pay tax, right? S corps literally don't pay taxes. They're a pass-through entity. C corporations are where you get into the big ones, right? The Exxons and the Amazons and all of that kind of stuff. And there is tax on C corporations.
So 40 to 50 is our answer as a rough kind of piece. As you can see, there's a lot involved in the right time to shift from one to the other. We'd like to extend just open feedback. If that's something that has a lot of interest, we would be happy to sit down and do an entire session on just all the pieces of that. So feel free to send your feedback to us, and if it generates enough, we're happy to take a dive session on exactly all those pieces.
Yeah, great plug, Charlie. Shameless plug for sure.
Thank you, guys.
All right, Clark.
So one more question for today. So I'm new to investing, just getting started. I have about $5,000 that I want to invest. Should I go Roth or traditional IRA?
Oh my gosh. Okay.
I told you I'm going to get you out of the tax comfort zone, but I know you guys still have
buy
some
a
good.
safe, put it in your floor. No, he would do.
No, Charlie, no, bad. Again, Charlie and I differ in our opinions, right? And so Charlie might put it under his mattress. I would not. So this can be a really lengthy subject, but let's try and boil it down so that we can just give you the best quick answer that we can, because the easiest answer is it depends, but I'm not going to leave you with that. So if you've got $5,000 that you want to invest, and Clark, I'm sure you picked that number deliberately, right? Because there are annual contribution limits to a traditional IRA and a Roth IRA. You can only contribute so much.
Right.
It's also important to note that there are income levels that stop you from being able to contribute to these accounts in some cases. I'm not going to dive into the nature of these accounts. So just for our answer today, let's assume that you already know all of that and that you qualify. And you're really just trying to decide traditional or Roth.
Right.
Oh, Clark, this question. Okay. Again, I'll try and make it as quick as I can, but this is really complex. The traditional IRA, the benefit is that you put the $5,000 in, and then you get tax savings from putting that $5,000 in. You get to write that off right away. Yes, exactly. Year one, you put that money in, and you get the tax savings right away.
Like return on investment year one.
That's right.
Okay.
Yeah,
right.
absolutely. So the higher tax bracket that you're in, the more valuable that is to you. If you're in a 10 or a 12% tax bracket, contributing to a traditional IRA probably is not ideal, right? Because you're only getting so much back on that. However, if you put the $5,000 in a Roth IRA, the Roth IRA is very different. Roth IRA says, too bad, so sad. You still got to pay taxes on the money. So you took the 5,000, you put it in a traditional IRA, you get to deduct that. But the Roth says, no, you don't get to deduct that. You still have to pay taxes on the whole 5,000 that you earned in that scenario.
Right.
And you don't get to write it off. You're going to pay the taxes on all of it. Well, that's a raw deal. Except then the money in both of these accounts, by the way, these are what are called tax deferred accounts, which means the money over the length of these accounts' lifetime, that money is not taxed as it goes up and down and up and down and up and down.
As
right?
long as it stays inside the account. So market goes up, market goes down, you get dividends, you get interest, you're not having to report any of that ever while it's inside.
Absolutely. And so I asked clients, did you sell any stock this year? Yes, I did. Well, okay, we might have to have tax documents in regards to that. Well, it was in my IRA. Oh, well, no, never mind. We don't need tax documents. You're not going to get tax documents. It all happens behind this tax deferred account, which is great because the more money that you have in that account, the more it's going to grow for you. But the more tax you pay, the less money you have in the account, right? The less money you have in the account, the less it grows for you. So the nature of compounding interest is in favor of the traditional IRAs because we all have a finite amount of money. We only have so much. And so there's only so much you can afford to put in these retirement accounts. And so in that way, you can put more. You can usually afford to put more in the traditional IRA because you save more on taxes day one, right? Right away, you save more on taxes.
Right, so if you could put 4,500 into the Roth IRA, but you could put 5,000 because you could add immediate deduction. That's something that Kevin has very kindly taught me on was just the concept of
principal investing power.
That one.
The more capital you have to invest, the more money that can earn you in the long run.
Correct.
So traditional is starting to look pretty good, right? Until we start talking about the benefits of the Roth. Now the Roth, the tax benefits are big time, but they're not now. They're not right away. You got to wait for your benefits. Tax deferred all throughout. If you meet two rules, then you get the benefit. And I'll explain the benefit in a second. First, you have to attain the age of 59 and a half. That's rule number one. You got to attain the age of 59 and a half. Number two, the account has to have been open for at least 5 years. If you open the account when you were 57, it's not going to fly. You got to wait a little longer. It's got to be open at least 5 years. And you have to attain the age of 59 and a half. Assuming you meet both of those requirements, distributions from your Roth IRA are tax-free. $0 of tax. Now, the traditional IRA, you put the money in, you get the tax break. It's tax deferred all throughout the years. Now you're 59 and a half and you take money out. You have to pay income tax like regular on this money. Now remember, you got to deduct it up front. So if you were in a 32% tax bracket up front, right, you put the money in, you get the write-off. And then when you're 59 and a half or 60 or 70, right, retirement age, you take the money out. And let's say you're in a 22% tax bracket or even a 12% tax bracket. You're saving a ton in comparison. And that's fantastic. You also had more money in this account than you had in the Roth because you had more money to be able to put in there because you saved money up front from the traditional IRA, right? You tracking with this, right? You seeing how this works? But the Roth, man, oh my gosh. So
retirement planning for your portfolio, maybe not everything in, but having a piece of this that you can plan on to distribute when you need, as you need, et cetera, that you're not paying any taxes on, can help keep your other income at that lower tax rate. And so it's difficult to say which is better because in the answer of it depends on you. It depends on how you feel, right, about getting deduction now versus not. But also it depends on your retirement plan, how it's structured and what it's going to end up being. Nobody has a crystal ball.
Yeah.
But having that retirement plan to say, we're going to do this, and this, working backwards would help you dictate what is going to be the right thing.
Yeah. And so let me just leave you with some numbers on this answer to help put it into perspective. The traditional IRA, I put $100,000 into over the course of my life. And by the time I'm 70, when I want to take some of it out, it's now $500,000. Okay, that's depending on when you put the money in. That is very reasonable rate of return over an extended period of time, right? Let's say I started in my early 20s. That's very reasonable that money would be $500,000 by the time that I'm ready to take it out. And so I'm not going to take it all at once, but let's say I'm going to start taking money out. Every dollar of that is taxed. Every dollar. No matter what. So I will take out that money over the course of my life, hopefully leave some of it to my kids, but I'm going to pay taxes on all of it. Now let's use the same example with a Roth IRA. Let's say that I put in $80,000 over the course of my life. I got to put in less because I have less money because the traditional IRA saves me money up front. So I put in $80,000, and that's $450,000 by the time I'm ready to retire and I start taking money out of it. I don't pay a dime of tax on any of that $450,000. None. I can take it all out day one and just put it in my savings account. Now you should not do that, but because you could and not pay a dime of tax. And so the Roth, for people who are future oriented, is very attractive. For people who are, I need to worry about my finances right now, and all of us do, right? But for the people who just really only have so much right now to be able to contribute, oftentimes gravitate toward the traditional IRA.
I want to do a small, real quick plug in this and just how the pulling money out works. There was a individual, and it was a very frustrating pain point for this individual. I can see it easily being translated to a lot of other folks. Is you invest when you're inside of these accounts. There's different things that you have. Let's just pick easy ones: Google stock, Amazon stock, right? You're invested. Sometimes investments go up. That's the plan. Sometimes they can go down. If you have a very large portfolio and there is a downturn, there was an individual who tried to pull the money out to capitalize on that downturn. Sadly, what happens is it does not matter the performance of the retirement account. When $1 crosses the line, that dollar has its own tax treatment. The account could have gone from $500,000, please never happen, down to $200,000, and you pull that $200,000 out. You have $200,000 of income if you have to claim it.
Yeah, you don't have a loss. You don't get a deductible loss.
Nothing.
Yes, you lost money.
Correct.
And we recognize that that's the case, but it was tax deferred the whole time,
Correct.
which means you never recognized it as income, which means tax-wise, you're not experiencing a loss. That $200,000 is all gain.
Yeah. Right. So it's just a thought out there to have that piece in, because there was that memorable thing for me that I went through. It was even emotional at that time to explain this is how it actually works. So just in case that's how that, while we're talking about IRAs.
Yeah. Okay, great. That's going to do it for us today. Thank you so much for joining us. If you would like to learn more about Charlie and I and about our company, it's molentax.com is the website that you're looking for, molentax.com. And you can find us there. If you have feedback for us or want to give us some topics that you would like for us to discuss in this podcast, we have quite a few that we are very ready to talk about, but we've got the ability to interject at specific requests. And so please reach out to us. Again, go to our website, molentax.com, and we're happy to help you. Thank you so much for joining us, and have a great day.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.